today is another event of our series of conferences on fintech, organized here at the Cyber Justice Laboratory of the University of Montreal. The cycle aims to present a critical and practical view of the subject. So through the cycle, we have invited scholars to look at the scientific perspective from different disciplines, be it law, computer science, economy, politics, but we have also invited some industry players in the field of finance and fintech in order to examine the practical application of these theoretical solutions. So that's the kind of biggest scope of our cycle of conferences. Now I would like to pass the floor to our director, Professor Karim Benyklef, to introduce today's talk and our valued speaker.
Thank you very much, Mark. Hello, everybody. Bonjour à tout le monde. I will introduce very briefly Professor Gray. Professor Gray's research focuses on the legal design and regulation of money and finance, including digital fiat currency, as well as broader issues of law and political economy. He teaches contract, business organization, and securities regulation. Professor Gray is also the research director of the Digital Fiat Currency Institute, consultant to the UN International Telecommunication Union's focus group on digital currency, and a network manager with the Freedom Box Foundation, which develops privacy and freedom respecting software for personal use. He's also president of the Modern Money Network, promoting modern monetary theory, which can be encapsulated in John Keynes' word, whatever we can do, we can afford. And I look forward to hearing from him. Thank you very much, Professor Gray, for accepting our invitation. The floor is yours.
Thank you very much for having me. It's a pleasure to be here. Let me just share my screen. All right. Is that okay? Can you see that? Everything?
Yes.
Okay, great.
Fine, yeah.
Thank you. Yeah, so the topic of today is looking at the role of privacy, or the implications of taking privacy seriously, to conversations about the design and regulation of digital currency. I've got into this work at this point now about 7 to 8 years ago. I came from a background in money and macroeconomics, particularly in the aftermath of the global financial crisis, looking at questions of budget issues, banking regulation, and concerns about inflation, concerns about price stability, full employment. And I was always interested in technological issues, but one thing that really drew me to the sort of emerging area, which at that point was still relatively young, of digital finance and digital currency, was that some of the biggest questions, philosophical, but also policy and legal questions about money. What is money? Where does it come from? How does it get its value? How do we create it, not just sort of technically, but in a sustainable, equitable way, were questions that most people were not thinking about on a day-to-day basis when making macroeconomic policy. In budget debates, in debates over price stability, usually those kinds of questions were already taken for granted. And if you are interested in critically evaluating those questions or revisiting them, even in the aftermath of the global financial crisis, there was a lot of resistance. But when I started looking at fintech, financial technologies, and I began by looking at the rise of mobile money in sub-Saharan Africa and in developing country contexts, it became clear to me that the kinds of questions that are interesting, that really might shape a whole range of policy issues that we look at, are ones that policymakers and others are willing to consider, are willing to revisit, if it is understood in terms of technology, if it is understood in terms of the next generation of financial technology. Suddenly, questions that people were not wanting to talk about, or not particularly interested in were back on the agenda. In order to understand how to build a new form of digital money, we have to understand what money does today, what its core features are, what the difference between different kinds of money is. And as a result, I found myself increasingly drawn to the fintech debate because it was a place to revisit some of those first principles questions with a more open mind. So with that in mind, I want to start sort of not in the 21st century or even in the 20th, but to go quite a while back to what I consider to be the beginning, the long view, which is that we can sort of think about the origins of financial technology in the very earliest forms of recorded money. There are different ways that we can understand what money is. One way is as a legal technology, as a legal phenomenon. And a lot of the work of colleagues of mine in the realm of the law of money studies would look at it that way, including some of the economists from the modern monetary theory school. But another way, a complementary way we can understand money is from a sort of physical material level. Money is what payment systems do. For money to exist, it has to actually be embodied in some sort of system. Now, that physical system does not have to be an object. It doesn't have to be something we can hold. It can be abstract. But even those abstract systems still have a material technology. And when the curtain goes up in the historical record on the kinds of archaeological artifacts that we now associate with money, it's about 6,000 to 8,000 BC. And the earliest things that we see are actually tokens. They are 3D representations, usually of goods and services that are being provided to a public authority in exchange a receipt of goods and services, so that when the time comes to pay taxes or fees or fines, it is the receipt that can be provided to the tax collector. Over time, according to the archaeologists who led the study of these tokens, to prevent counterfeiting and to particularly prevent fraud in tax collection, many of these tokens were placed inside of clay tubes, and what was contained inside, the contents, were recorded on the outside of the tube, so that the tax collector would bring the sealed tube to the central authority from the outskirts of the region they came from, and then break it open, and it would contain the same things that it contained on the outside. Eventually, it was realized that the markings on the outside were actually more important than the tokens inside. As long as the markings on the outside were valid, then that was all that mattered. Rather than holding those tubes in a 3D way, they started to roll them flat. And so you started to have the origins of what we now consider written records out of a sort of 2D flat representation of these 3D tokens. But over time, both tokens and accounts existed in parallel. Obviously, most of us know about coins. Coins really didn't become popular until the 6th or 7th century BC in Greece and Lydia and other places in the Mediterranean. And later on, we saw the rise in China and then later on elsewhere of paper notes. But there are other kinds of tokens as well. Perhaps my favorite, and one that I think has relevance to today when we think of modern cryptography and the technologies of cryptography that are used to secure digital tokens. One of my favorite technologies is called the tally stick, which was a piece of wood, just a strip of wood that would have notches written on it for what amounts it was supposed to represent. And then the piece of wood would be split into two. And one piece would be kept by the issuer, and the other piece would be issued into circulation. And when the time came to accept back the issued piece of wood in payment for taxes and fees and whatever else the authority that issued it was accepting back, they would match the two pieces of wood together, and that would prevent counterfeiting. This was actually probably the most commonly used kind of public financial instrument in England, for example, for a significant part of the Middle Ages and until in the 19th century, the stock of old tally sticks was actually burnt in a large fire at the Exchequer. A lot of those records were lost. But if you think about today, for example, in the context of modern cryptography and public key encryption, the idea of having a pair of tokens that are uniquely connected to each other as a way of preventing counterfeiting actually has its origins in physical instruments. Digital payments in this world have an origin much older again than even the 21st or the 20th century, back to the early 19th century. It was only shortly after the first telegraphs were set up that the telegraph network was used for wire payments. The interesting thing about these systems is that at this point, the actual record keeping, the actual instruments themselves were still largely analog and physical. What the telegraph networks were used for was transmitting information about those systems. So a bank on one side and a bank on the other side would communicate information about a transfer using the telegraph or the wire, and then would settle that using either physical currency or their books, their book entry account system. So even at that point, there was a distinction between the money thing or the account-based money and the communications network that would transmit signals about that. Over the 20th century, you started to see the rise of actual e-money itself. Rather than simply payments or the communication of payments, you saw the rise of specific instruments, first of all, cards that would then signal a claim over an account. And later on, the rise of a specific digital balance from about the 60s onwards, where the actual evidence, the account entries, were stored on a digital computer or in a digital database. This really kind of became more and more popular through the rise of debit cards and credit cards. We associate this today with the rise of things like American Express, but they actually had their earliest origins in a set of charge plates that were again issued by Western Union and others, and then actually individual businesses. Before finance took it over, it came out of the realm of telecommunications and large department stores. It was only, I would say, really in the 90s that the kind of internet money or telephone money that was starting to be popular in the 80s really hit its stride. And in the English-speaking Western world, probably the most famous company for this was PayPal. Now, interestingly, PayPal and other actors at this point did not become a bank, did not get a banking license to issue a form of publicly backed public money or bank deposit money that is insured by the government. They issued their own liabilities, their own obligations that then were backed one-to-one somewhere else with bank deposits. And the idea there was a secondary layer of obligations that the internet money operator, the e-money operator, would be liable for. This has its origins in, again, Western Union, but had a significant impact on the safety of those systems, because government insurance of banking played a very crucial role in the 20th century of stabilizing the value of bank money, whether it's account money or bank notes or checks. That the kinds of recurring crises we saw in the 19th century were in part fixed by the government saying that we will backstop, we will turn your private money into a form of publicly insured money. And if we think of the banking system today as a sort of public-private partnership, on one hand, it is banks themselves that issue their own deposits. You take $100 to a bank, they own that $100 bill, they give you a $100 deposit. Or if you get a loan from a bank, they don't even take that money from elsewhere. They simply mark up your account with your loan balance, and in doing so, create deposits out of thin air or out of the lending process itself, which led central bankers to describe bank lending as fountain pen money, because the act of signing the loan with your pen created the money. If we think of that as a public-private partnership, PayPal is a sort of additional private layer built on top of that public-private partnership. And in the process, makes the payment system and makes the financial system more complicated, more fragmented than it was in the past, or in a different system where most people were using regular bank money for their primary form of digital payments. The 2000s, I would say, were defined really by two different technological revolutions. And I use the word revolution here, not in an engineering sense. I'm sure there are engineers that will have strong criticisms of how novel or particularly useful some of these developments were. But in a cultural and social sense, and certainly I would say in a commercial sense, these two developments played a massive role in reshaping the monetary and payments landscape. And again, they have obviously older histories, but I would say it was really in the 2000s that they both took off. The first I would say is what I call the hardware revolution. And this is really the rise of mobile phones. Obviously, again, mobile phones have origins going back to the 1980s and early 90s. In many respects, internet banking and telephone banking was already well established by the mid-2000s. But up until that point, most people would consider or would use internet or online banking primarily either at home using a personal computer or through a phone at an office, or even at a phone booth or something. And most payments in stores, most payments between people were either made with cash or with a card using a dedicated point of sale terminal. And so if we think of the network layer, the payments networks were either running on a sort of traditional internet hardline network, or were using their own dedicated point of sale networks. With the rise of mobile phones, and in particular, I'm talking about the rise of mobile phones in places that did not have developed banking systems. So, a colleague of mine from Haiti, used to say that tax collection rates, in Haiti were extremely low, but there was a 90% plus cell phone penetration rate. And in places like Kenya, trust in the banking system is quite low, but Safaricom, the large telecom provider there, enjoyed a relatively high level of public trust. And the rise of people who would have, not necessarily smartphones, but a phone capable of making text messages and basic calls and things shot up in this period in places that otherwise still had relatively low standards of living or low levels of average per capita wealth. The effect of this was that for the first time, individuals became their own digital point of sale terminals. You go from a network where only merchants have the ability to process payments to a world where every person has a computer in their pocket capable of processing payments, or at least connecting to a network that processes payments. This has a pretty transformative effect. And one of the earliest ways in which these systems operated was not actually by issuing their own form of e-money like PayPal, but was actually through issuing their own form of airtime minutes, mobile minutes that could be used to pay your phone bill or pay for text messages or calls. The effect of this was that the value of these airtime minutes was somewhat stabilized early on, not through partnerships with banks, the way that PayPal did, not through piggybacking off of the existing banking system, but through the ability to use these tokens to pay a fee, pay a tax, pay your phone bill. And this often happened even without the advent of apps, simply through systems where you could send a text message to someone, and doing so would top up their respective account. The other revolution that took place at this point, and I am sort of putting it at a historical moment, is the rise of cryptographic software. And obviously, and I probably don't need to go into too much detail to this audience, this has its origins back with the cryptography from World War II, which at that point were considered military secrets, military technology, all the way through to the rise of the cypherpunks and other internet activists in the 1980s who saw privacy respecting communications, which included transactions, right? Included a form of digital money that would not require, could not be censored and would not require a centralized point of failure as a goal of the kind of internet freedom movement. Things that at that point in the 80s seemed very far off in the distance. By the 2000s were becoming a lot more mainstream, a lot more dystopian concerns for surveillance, a lot more concerns for totalitarian control of information through government regulation of internet networks, those kinds of things. We were living in the aftermath of the first big round of internet regulations in the mid to late 90s. And since the 80s, there had been experimentations with different forms of privately issued digital cash or digital payments technology or digital currency in general. I would say that until about the mid-90s, a lot of the emphasis, a lot of the focus was on technologies that could ultimately be sold to banks or governments. But in the face of general apathy or even active resistance from banks and government policymakers, a lot of the cypherpunks and a lot of other cryptographers interested in digital currency switched their focus or pivoted to systems that did not have a central issuer. So one way to think about that is that until that point, the focus was on private payments technology. And after that, the focus was more on private money itself. Money that had to have a theory of issuance, a theory of value, distinct from the kinds of public money or even public-private partnership money that have dominated up until that point. Different technological innovations, different little cryptographic and other security problems were solved, including perhaps most famously the Byzantine generals problem with Satoshi Nakamoto. But at least in my telling of this story, it was only really with the global financial crisis in 2008 that the conditions were right socially for large-scale interest. And at that point, trust in governments and trust in traditional financial institutions was at a generational low point. And the arrival of Bitcoin happened sort of right at the same time as the rise of social media. And those different forces combining created a kind of perfect storm where instead of simply saying the problem is with corruption in the banking system, the problem is with mismanagement of public money, the criticism from this particular world was that the problem was actually that public money itself is unsalvageable, that the fiat currencies issued by governments, official currencies, were doomed to failure. They were doomed to lose value over time and to always become engines of corruption, mismanagement, totalitarianism. And of course, that picked up with a certain segment of the population. And as more and more money became invested in these assets, in part because of the high speculative returns, these narratives sort of became more and more mainstream, even outside of the libertarian political ideology, or even outside of the Austrian economics that it came from, that emphasized sort of the value of hard assets and commodities like gold as a backing for money rather than public law and public authority. And once this happened in 2008, we saw a kind of larger breakdown in the discourse around money and macroeconomics. Now, as a legal scholar, I saw a rise. I was a law student at the time and then I made my career in this area. I saw a rise of scholarship around money itself. Up until that point, there was very little explicit legal scholarship on money, at least in the English-speaking world. But afterwards, an emerging discipline started to arise. Areas in law and finance and securities regulation and payments law started to connect more explicitly, and things like law and macroeconomics, which was a very under-researched area, became more and more prominent. So it was against that backdrop that digital currency became its own subject of interest, and of course brought a whole host of legal issues right as the legal, academic, and regulatory world was rising to meet it. The cypherpunks at this point basically, I would say, rode the wave of populist resentment against fiat currencies, but also rode the wave of technological fear or technological confusion that comes from policymakers. And you saw this perhaps most obviously in the limited regulation of crypto in that early period. From about 2011 to about 2017, federal regulators were extremely slow to respond to what was going on in the crypto industry. Questions of whether or not digital coins were money, were they property, were they commodities, were they securities, were questions that regulators sort of ummed and ahed about, but generally took a light touch approach, even as the underlying political claims about what money does and where it comes from were sort of actively resisted. Policymakers were pretty explicit that money was a public official entity. It had social concerns, and this idea of kind of relitigating the merits of the gold standard, or relitigating the merits of an apolitical money, was not really on any large political agenda, even if the broader question of what to do about crypto was. And of course, you start to see a convergence of the hardware and software as more and more of the crypto world starts to be built around apps, and smartphones start to integrate mobile money, PayPal, internet banking with this emerging world of fintech. And you can see in the ideology of Bitcoin from the very beginning, in its DNA, was this opposition to public money. The narratives you hear about it today are quite different from the narratives you heard back in 2011. At this point, it was designed to be privacy respecting cash, right? The original white paper talks about a peer-to-peer payments network. And a lot of the criticisms at the time were about the devaluation of public money. Banks were printing money, governments were printing money, right? Your wealth was going down. What might have begun in the 1980s with the cypherpunks as a concern about totalitarianism, as a concern about censorship of payments and privacy, was in large part replaced at this point with concern for soft money, funny money, Keynesian money. And in that respect, you could call this the sort of libertarian or gold bug takeover of the cypherpunk vision. There was some of that going back to the 80s, but a lot more of it was in line with the kind of anti-surveillance, anti-censorship dimension, which nowadays is still in the mix, but with the rise of large Bitcoin mining companies, with the rise of a whole number of additional privately issued coins, some of which are quite centralized, some of which give the appearance of being less centralized, but are still quite centralized, or still have, a governance regime. This idea of sort of anonymous digital cash money has really receded into the background. And at the same time, there's this idea that crypto is the opposite of political money. Right? Politics is human beings and mathematics is apolitical. And so if you don't trust governments, if you don't trust political authorities, just trust the math. In reality, of course, the idea that crypto is actually apolitical, I think, is a fiction, and has been revealed to be a fiction as you start to see the actors involved in it. But perhaps most importantly, in the last 4 or 5 years, the most important, I would say, crypto currency projects or parts of the ecosystem are not the privately issued currencies like Bitcoin or Ether, but are in fact stablecoins. Stablecoins are simply a privately issued digital financial instrument or balance that promises a fixed amount in a official currency, a fixed amount of value. You put in real dollars or you put in other crypto assets, you get something worth $1, and that value is stabilized through either some assets or an algorithm or a link to a bank account like with mobile money. But importantly, the function that stablecoins served was a place to store your funds while you bought and traded other crypto. In one way, you could think of this the way that bank deposits used to work, or even money market fund accounts used to work. So stable coins, even though they emerged out of the crypto industry or the crypto space, at least in my view, have a lot more in common with bank accounts, with bank deposits, with banknotes, with money market fund accounts, with shadow money, official money in the unit of account of the government, but privately issued. And with it, risks that its value will go down like bank money used to have before deposit insurance. So despite saying we want to be completely apolitical, we're building our own currency system away from the government, away from the old world of official currencies. Today, crypto as an industry, as a sector, is increasingly dependent on stable coins. They are the largest trading pair in and out of other currencies. They are the source of liquidity. They serve as the on-ramps and off-ramps for actors to bring in external funds. And companies like Tether and Circle USDC and Paxos and Gemini are some of the largest, most profitable ventures in the whole crypto sector. And traders on the largest exchanges, including Coinbase and FTX and others, are dependent on stablecoins as a vehicle for making payments and holding funds. But there is no way to understand stablecoins as anything other than political and connected to public monies. The other thing that we saw in 2019, and I would say after 2011, or 2008, sorry, and then perhaps after the crackdown on unregulated coins in 2017, probably the biggest move was the announcement by Facebook in 2019 that it was going to enter payments with its own global currency at that point called Libra, now called Diem. Facebook, with its characteristic ambition, claimed that it wanted to become the internet of money. It focused at that point very heavily on a global framework, specifically looking at things like remittances. Its currency was supposed to be its own global unit of account that people would transfer in and out of from their local currencies. And at that point, it was going to be chartered and headquartered in Switzerland for favorable legal regulatory reasons. Following a huge amount of pushback from around the world, it has moderated its initial ambitions and is now trying to create a US dollar denominated stablecoin connected to a single bank in America and getting licenses there. But I would consider this a setback rather than a real kind of complete abandoning of that larger global vision. And already today it's engaging in trials with remittances between the United States and Guatemala. Of course, Facebook was not the only big tech company to get involved. Google Pay, Apple Pay have been around for a long time. Amazon's involved. Famously, in the mid-2010s, Walmart tried to get a banking license to get involved and create its own basic debit card. So as the world moves towards sort of data and platform management as the dominant winner-take-all model for big business, fintech becomes a very valuable layer of that ecosystem, a valuable terrain to fight over. And Facebook really became I think in part because of the clumsiness of its rollout, became the boogeyman for public regulators and politicians to grandstand, but was really just the straw that broke the camel's back in terms of the transition of big tech to big fintech. And of course, early on, that Libra consortium included not only Facebook, but Uber and Lyft and the ride-sharing companies. It included traditional telecom companies like Vodafone, and included other payments companies like Visa, MasterCard, PayPal, and a number of these ended up backing out over time, perhaps after they got a chance to see enough behind the hood. But what we're talking about here is certainly not a group of computer hackers trying to resist big business or anything like that. And although Facebook and the Libra project proposed that their initial network would be respecting privacy, would be end-to-end encrypted, would function like cash, even from the very beginning, there was murmurings that over time they would begin to offer credit products linked to people's digital data profiles, that they would take data from their other platforms and use that to inform the kinds of products they provided. So this was, from day one, a data initiative as much as a monetary initiative. And of course, many of those early adopters of Bitcoin and others who were very opposed to politics, at least publicly, were quite happy to jump on board, suggesting, at least to me, that the concerns about privacy and concerns about large concentrations of power in the payments industry were maybe more of a cynical marketing ploy than a deeply held ideological conviction, at least for those at the very top of the industry. One of the responses that came out of this, which I had some involvement with, particularly related to stablecoins, was the rise of regulatory responses aimed at different sectors of the crypto industry. Others focused on things like Bitcoin and Ethereum and other coins as securities, suggesting the securities laws should do more. This bill, called the Stable Act, which I was involved in drafting, and is going to be reintroduced this year, but also formed some of the basis of the President's Working Group White House report on stablecoins that came out at the end of last year, amongst other things, proposed regulating stablecoin issuers as banks, explicitly identifying stablecoins as a form of shadow money, and requiring the same kinds of safety protections for stablecoins that we have for other banking products. And I believe this is an important intervention to prevent the rise of sort of shadow banking risk that we saw in the money market fund industry in 2008, and then again in 2020, with unregulated deposits before 1930s in the United States and elsewhere, and things like privately issued banknotes from the 19th century. But one of the responses that came out from the crypto industry was that to accommodate this law, to make this possible, would require the kind of monitoring of these networks that would destroy any privacy. And so one of the dimensions that came up here is, how do you balance monetary concerns, monetary stability, banking stability, with privacy? How can you ensure that the instruments themselves are not shadow money that could break, could end up defaulting, that give the appearance of safety until they have a crisis, while simultaneously not requiring a level of transparency and visibility that undermines any sense of privacy? So the Biden administration sort of picked up on this issue and started pushing this idea again that stablecoins are really closer to bank deposits and should be regulated with proper insurance. But at the same time, perhaps even more important from their point of view than regulating it as insured entities is to ensure that those issuers comply with anti-money laundering, know your customer, counterterrorism rules. So you end up having this parallel debate, on one hand about financial stability, and on the other about legal security and criminal law prevention. And the battle lines end up, unfortunately, in my opinion, getting drawn where to be on the side of the government or public sector was to be both supportive of financial safety, but also supportive of police security issues. and to be on the other side, to be pro-privacy, was also to be pro-private money. And at least in my opinion, this was a real missed opportunity. This was a real a failure of progressive civil libertarians, privacy advocates, to articulate a more nuanced position that separated out the question of privacy from the question of private versus public money. And I'll get to more of this in a minute, but the most obvious example of this is cash itself, which is publicly issued, but respects privacy and anonymity much more than a lot of stablecoins and privately issued monies, but have none of the risks that the instrument itself could default. With the rise of Facebook, you saw a public response. For the first time, in my experience of doing this for about 6 years at this point, public authorities said, well, we probably need to do something. When I would speak to central bankers around the world about issuing their own digital currency, about government digital currency, before 2019, the overwhelming response was, this is interesting. This is, there's maybe something here, but it's still early days. We're not really sure. We need to do more research on it. We need to see whether there's any use case that existing banks are not already providing. After 2019, that rhetoric shifted remarkably. A number of countries had already started experimenting: Ecuador, China, a few small Caribbean countries. But really after 2019, it became less of a question of if and more a question of when governments would start issuing their own currencies. And you can see this in the Bank of International Settlements surveys of central bankers and policymakers at the time. They jump after 2019. And you can also see it in specific strategic decisions. For example, the former managing director of the IMF, Christine Lagarde, was one of the earliest high-profile policymakers to say quite affirmatively that she thought digital currencies would be useful. And after making those statements, she was appointed to be the head of the ECB, which to me at least was a signal that the ECB was interested in going down this route, amongst others. Governments getting involved, governments starting to issue their own currencies. The overwhelming framework of this was what we call CBDCs, which stands for central bank digital currency. I've been on the record saying I think this is a problematic way to think about it, because the only thing that you're actually clarifying when you call it a CBDC is that it's going to be issued by one entity, the central bank. But in the United States, at least, in a number of other countries, central banks are not the only monetary authority in the government. They provide bank accounts for banks. They do clearing and settlement of account-based money. But in a lot of jurisdictions, it is other entities like the Mint, or in some places a Bureau of Engraving and Printing, or a monetary authority that will issue the coins and the notes. And the central bank might not be involved at all, or if they are, they'll be involved in simply shipping the coins and notes that are made elsewhere. And then, of course, in a number of countries around the world, you also have things like postal banking, where in contrast to the central bank, which is really up here, and then it provides services to banks, and then banks provide services to regular people, postal banking provides services directly to retail markets. So you had a lot of debates amongst central bankers about how a central bank digital currency should be designed, how it should be issued, that started from premises like, one, we do everything in partnership with commercial banks. So any central bank digital currency we issue should go through central commercial banks. Of course, a postal banking system doesn't have to deal with that. Two, we don't provide direct retail services, so we're not sure we should get into providing retail services here. Of course, a postal banking system or the Mint doesn't have to think like that. And three, the central bank saying, well, of course, any instrument that we issue must comply with anti-money laundering laws, know your customer laws, counterterrorism laws, similar to a bank account, which again, physical cash, notes and coins do not have to apply. So my take from this, my observation, was sort of like that old line that has been apocryphally assigned to Henry Ford, where he said, if I asked the public what they wanted when I was designing the car, they would have told me a faster horse. You ask central bankers what new digital technology can achieve. And 9 times out of 10, they'll say a better bank account. But that's not because that's the only answer. It's because they're bankers. They are not the people that make coins and give them to children, and they're not people that issue notes and ship them to stores. And from their point of view, the dominant form of money is the account system. If you're talking about high values, high denominations, most people keep their money in accounts. The stuff of tokens, of physical instruments, is almost quaint. It's almost outdated. And it's certainly very low on their priority list. It's the kind of stuff that people use for purchases under $25 in America, for example. Now, there are people at this point in the last few years have been talking about returning to postal banking as a form of financial inclusion, both at the federal level and at the state and local level. In the United States, for example, and elsewhere around the world, there already are public banks. But again, most public banking has been focused on account-based systems and not so much on tokens or cash-like instruments. But what the rise of postal banking has allowed is a conversation about A, providing direct public services to people, and B, to think about privacy and information. Right? The Postal Service being one of the last government agencies that has a respect for your privacy more than private entities like digital platforms. Right? You send a piece of mail. In most countries, the government is not opening that piece of mail and reading it, even as it provides that network to people to transact. And what you're starting to see come out of central banks is what I consider to be basically doublespeak. The idea that they are striking a balance between privacy and security, between things like deterring money laundering and illicit activity and privacy. But the way that that's often being framed, if you actually dive into it, this is the Federal Reserve's report that came out a few days ago saying we need to strike an appropriate balance. But if you actually listen to what regulators say, is that anonymity is not an option. That anything that we build at the central bank will have a backdoor. It might actually just have a direct common ledger where all transactions are recorded at the central authority. It will certainly be subject to de-anonymization and things with a search warrant. And at least from my point of view, this is not a balance. This is not a reasonable middle ground. This is actually a radical departure from the systems that we have enjoyed for thousands of years. For thousands of years, we have had both a token option and an account option available to us. In some historical periods, the tokens actually were high denominations. Nowadays, they're more smaller denominations. But a world in which we do 99% of our transactions online, where there is no option to transact anonymously or to transact between you and I directly without it going through a central authority, a central ledger, a central account, is an extreme departure from the privacy standards that we currently enjoy, or at least that we've enjoyed up until very, very recently. And of course, more broadly, going beyond the realm of currency and payments, we are living in a specific moment when there is growing recognition around the world that both private industry and public authorities have violated some of the most important aspects of the social contract when it comes to respecting our privacy and not engaging in illegal surveillance and wiretapping. So against that backdrop, the idea that we will just trust the government to replace all public money with something that is capable of having a backdoor built in or capable of being surveilled, I think is a very naive position, and one that has the potential to undermine public adoption of the currency itself. The easiest way to ensure the private dominance of payments and money in the future is to create a public alternative that is so bad that the public has no interest in using it. And I think that when it comes to these privacy issues, if you read the surveys of consumers or the unbanked, millions of people, even in developing countries like the United States, who are unbanked, one of the primary reasons they are unbanked is because they do not trust their money with banks. And if the alternative is for them to trust the same government that is spying on their community or that violates their civil liberties with impunity, that is a recipe for failure. And it is a recipe to give these private crypto ventures the upper hand morally to claim that they are the only ones defending privacy, even if that is not true. Even if it is not actually true that private crypto projects are on the whole more respecting of people's privacy, they will continue to be able to use that rhetoric to gain market share and to gain cultural capital. So I'm not the first person. I certainly don't think I need to go into a huge amount of detail in a series like this to point out that this idea that there's a sort of privacy versus security trade-off is a false one. Without sufficient security, without sufficient privacy, people will not trust these systems as secure themselves, because once a backdoor exists, it can be exploited by others. Similarly, when you actually want to have a system that can provide the kinds of privacy benefits that not only individuals need, but actual public authorities need, you need to design it in such a way as it's possible to do that. And this is why, for example, things like cryptography itself, but also today, some of the privacy respecting tools like Tor browsing and others are often actively developed by public authorities, because public authorities themselves have a need for privacy in their digital communications and digital data. And so in one respect, the idea that, for example, a government like Germany might want to be able to surveil their citizens may be true. At the same time, former Chancellor Merkel was quite upset when it came out that the United States was surveilling her cell phone as a sort of leader of a supposedly allied country. And what you've seen in recent years in Europe is the rise of open source consortiums providing alternatives to American companies like Cloud or Google Cloud or Slack, where the goal is precisely to host your own services with open source software, so that you are not putting sensitive government materials, whether it's the military or public sector agencies, in the hands of foreign companies. The other thing, of course, is that there's limited or no evidence of success of these surveillance regimes actually improving the outcomes they're talking about. A number of leading anti-money laundering scholars and others have actually identified a very, very small fraction of money laundering actually takes place with cash. The vast majority actually is about laundering legitimate money that otherwise needs to stay in the banking system. So it's usually involving corruption or crimes by banks through legitimate industries, through the on-ramps and off-ramps into highly regulated sectors, rather than simply storing, pallets of cash underground like you're a Colombian drug lord or something. So there is a credibility issue that comes with a lot of the law enforcement agencies saying we need these backdoors, when what might have been easy to push through in October of 2001 in the aftermath of September 11, it sounds a lot less convincing today. And lastly, and this is an issue that I think a lot of privacy advocates have been a little bit behind on really articulating the stakes on, I think in part because of the complexity of currency dynamics, is that on one hand, money laundering, even terrorism and things like that are serious social harms that we should be concerned about. But on the other hand, the loss of the ability to conduct private communication has small c constitutional and small d democratic implications. One of the cases that I like to talk about when I teach this is from the 1950s in the United States, involving the National Association for the Advancement of Colored People, the NAACP, the leading African-American civil rights organization in the state of Alabama, where the governor of Alabama wanted access to all of their membership records because the NAACP had a branch that was chartered in Alabama. And the governor of Alabama said, you are a corporate entity chartered with our state. We have a right to inspect your books and see all of your members. And at the time, the governor was a racist arch-segregationist who wanted to harass members of the NAACP. And they refused to hand over their membership list. They handed over other corporate documents, but they said that is private information, and the Supreme Court upheld that under the First Amendment. But that kind of capacity to engage in political dissent, whether it's funding Palestinian activists, which Venmo has blocked, funding WikiLeaks, which Visa has blocked, funding marijuana businesses, which federal banks have blocked because of concerns that they would lose access to the Federal Reserve System in the United States, or even things like sex workers, which various payments apps have blocked because of concern that regulators will come after them. The risk of having a surveilled payment system is the risk that any dissenting activity, any dissenting commercial activity will be unable to exist. And that is a much higher systemic risk, a more permanent risk. The loss of political dissent, the inability to organize money in the Arab Spring is a much bigger social risk than any single one money launderer or single terrorist or even child pornography. So I would say today there's sort of four visions for the future of money with different implications. One is in the bottom right down here, the sort of libertarian vision. You've got blockchain and DeFi and private monies that believe that if we can just build enough space away from governments, away from regulation, then we will protect our civil liberties and freedoms. And privacy, of course, in reality, they end up running headfirst into regulation as they grow and become more prominent. In the top right, you've got sort of traditional business, right? The regulated banking sector is getting into crypto, getting into their own forms of upgrading digital payments. And they've already sort of come to peace with a compromised position on privacy ever since, I would say, the 1970s, at least in the American context, with the Bank Secrecy Act. In the top left, you've got publicly provided government accounts, and there are concerns about privacy there, but they mostly are framed in terms of giving people access to protections the way that you might do with their tax records, things like that. We put all the information in a centralized account, but then we have protections around that system. And lastly, in the bottom left, the sort of civil libertarian view, I would say, is to try to build something that works like cash, where you don't collect the information in the first place, where the transaction happens with tokens directly between actors, and the security is validated at the token level rather than at the network transaction level. One way to think about this, and to go back to what I was talking about originally, is to think about a system with public money, with official money, right? No Bitcoin or Ethereum necessary, but with private payments. The way that coins work in general, the way that notes work, right? It's backed by the full faith and credit of the government, but the act of transacting happens between all ranges of private actors. So my overall principle for this is the last slide, thanks for your patience, is that we should be aiming to minimize the data that we generate rather than maximize it. Rather than collect as much data as we can and work out what we think about it later, that unless there is an explicit reason to collect it and store it, we should be designing systems not to store financial data. And when it comes to account money, we should be looking at the ways in which we have built privacy respecting layers around our accounts. So for example, we can write information onto a paper check. That paper check can circulate. That paper check is a claim on a bank account, but the act of circulating the check itself is not controlled by the bank. The bank issues the check, but you can hand that over and it can move around like cash. We could design a digital check that can function the same way. You could download your money from your account onto the check, hand the check over, someone could take that check, move it around, and when they wanted to cash it in, could go to a bank and cash it in without that ever actually having to move to a different account in a surveilled way. Another way that my colleague Raul Carrillo has proposed is a wallet attached to an account, or a wallet where you can make a transaction from one hardware-based wallet on a phone to another. This could happen for something like remittances, where the phones themselves store the funds and the phones can validate the transactions between each other. Another way would be to create some sort of trusted hardware environment, something like eCash, using either like a prepaid stored value card or a SIM card, as well as just laws protecting existing physical currency. My view is we need some combination of all of the above, but perhaps most importantly, we need to be restructuring this whole conversation away from that idea of a balance between privacy and security, which usually means killing existing privacy features, towards some sort of system where our first priority is to protect the rights and freedoms that we've had for centuries as we transition from a primarily analog payment system to a digital payment system. And that requires articulating, I think, an affirmative case for the value of cash and for the importance of anonymity in payments. Within limits, not saying billions of dollars or limited liability corporations, but individual people exercising voice and political expression through money to be able to do so at least to the level that we have enjoyed for centuries. So I'll end there. Thank you for your patience and happy to take questions.